Hi everybody, how are you doing? Welcome to today's webinar that's going to be presented to you by Strive Financial. But before we get there, first I'd just like to shout out to all our friends in Victoria. You guys are going to go through a tough 6 weeks. We know we've been getting plenty of calls here. I've actually just done a short video that'll be out on LinkedIn shortly and spread around various platforms. But most importantly, look after yourselves. Stay well, stay focused. And if you've got questions, what you need to be doing is get in touch with your aggregator or your lender BDMs and find out how you need to navigate whatever it is in front of you. So make sure you do that. Most importantly, we know stresses are going to rise and tensions are going to run high, but be kind to one another and you'll all get through this. Anyway, best wishes to all of our industry family down Victoria. So now, let's go on to the webinar. I had Cameron Garnham, who's the Executive Director for Strive Financial. I've known for God knows how many years now. And we're going to have a conversation, or he's going to present to you, and then we'll do a Q&A afterwards, of how to help clients with the right financial solution. Now, a little bit of background, although I've known Cameron and the company that he works with in his past life for, geez, even when I was brokering, so geez, that goes into the 2000 era. Cam's been involved in the medium and short-term lending space for over 13 years himself. He's got an intimate understanding as to how to recognise scenarios that will suit your client, and most importantly, and I guess this is the big thing, is how to look out for any warning signs that might happen during a process. So it's very important that we understand that as well. So I'm going to pass over to Cam in a sec, but however, if you've got any questions during the presentations, please put them into the chat box in your screen. Those messages will come back to me, and after Cam's finished his presentation, then I will go through your questions live with Cam as we're here. And even whilst we're doing that, if you've got any questions, you can still send them through. And Mariah, who controls our world digitally behind the scenes here, she'll make sure that I get them. So we'll do that after we've finished the presentation. And of course, like everything that we do here at the FBAA, if you want to watch this webinar again or share it with friends later, it'll be available next week on our YouTube channel, FBAA YouTube channel. And that will be there for you. And when we close off today, you'll also get your CPD code for an hour's CPD that you've conducted for being part of the session. All right, that's enough from me. I'd like to introduce and hand over to Cam to commence his presentation for us today. Thanks, Cam. I'll leave it with you.
Hi, Whitey. Thank you so much for the intro, and welcome to everybody. Now, this is my first crack at a webinar with the FBAA, and in the new world that we live in, I'll do my very best to try and make sure that we get it right. So hopefully everybody can hear me and everybody can see the presentation that we're going to move through over the next half an hour or so. So first off, guys, a little bit about myself. I've been with Strive Financial, Crown and Gleeson, and Australian Mortgage Fund as it was before it became Strive Financial, going back about 18 months ago now, since 2006. So I've seen a lot of deals over that time, and I've seen a lot of people use short-term lending for the right reasons. I've also seen some pitfalls that can be involved in short-term lending. And I guess what I want to speak to you guys all about today is making the right decision for your client, or being able to explain short-term lending to your client with some knowledge around how it actually works, because it's an industry that can have a poor reputation. And if you're not careful, and the wrong client ends up in short-term lending, then it ends poorly for everyone, including yourselves and your client that ends up in there. So over the next half an hour or so, please, if you've got some questions, send them through to Whitey. I'm more than happy to answer as many questions as I possibly can in the time frame. And hopefully we're going to be able to learn some things along the way with what we go through. Now, let me see if I can get this working. here we go. So the overwhelming feedback here, and this is from Kate Carnell, the small business ombudsman, from the small business community, is that there's a lack of access to funding is the biggest barrier to a business's growth. Now, I assume that all of you guys have mum and dads that have PAYG jobs, and you do finance for them, but you'll also have small businesses on your books as well that are always looking to grow. And their biggest problem is typically trying to find finance. So we've got some stats here that 1 in 2 small businesses sought finance in 2018, 2019. So 75% of loans averaging 800,000 was successful, and it drops all the way down to only 25% of loans averaging 2 million. So obviously, as the loans get bigger, it gets more difficult to try and get that funding settled somewhere. So the point of our session here is trying to work out what sort of client works in the short-term lending space. And over the last 14 or 15 years that I've been here, there's 5 questions that you can virtually sort out what client will fit in what sort of lending space by asking them. The very first one is, how long does the client need the funds for? If clients are going to fit into the short-term space, then they have to have a clear exit strategy, and that will have a time frame on it. So if they're refinancing their property, if they're selling their property, if they're a builder waiting on progress payments from the bank, if they're importing stock and that's going to go into their shop to then be sold, there's always a time frame around how long they need the money for. Now, what we don't want to be putting people into short-term finance is when they need the money longer term. If they say, oh, over the next 12 months, I'm going to pay out of business cash flow. That's a real warning sign that it shouldn't be a loan for short-term finance, because at the end of the day, if they're trying to pay out of business cash flow and we're adding another expense in the short-term loan interest that they need to pay, it's going to be very difficult for them to pay out through just business cash flow over the next 12 months. So it's very, very critical that we get the term of the loan right, how long they're looking to borrow the money for. The second question is, when are the funds needed by? There is always urgency in short-term lending. If someone has 6 weeks before they need the money, you guys will be able to take them to a bank and get them a refinance or get them a loan somewhere there. There is always a timing issue. So we're always solving a problem for the client, or we're allowing them to take advantage of an opportunity. That will always come with a timing issue. Clients need money by the end of the week to make sure that their wages are paid up to date. There's a container load of stock sitting on the docks and they need to pay for it to get it off the docks and into their shop. There'll always be a timing issue if it is a genuine short-term finance need for your client. Thirdly, what will the funds be used for? So all of our lending has to be outside the Consumer Credit Code, which means that the purpose of the funds has got to be for business or investment use. Now, a lot of people get confused here. It's not the security that the client's offering. So the client can offer security in their principal place of residence, as long as the money that they're borrowing is being used in their business. So can we lend money for somebody to buy a house in their personal name? No, because it'd be a consumer credit loan. Can we use a house that somebody already owns in their personal name as security to put $100,000 of working capital into their business, or to pay a $50,000 company tax debt? Yes, we can. So it depends on what the money's being used for, not what security is being used. So all of our loans have to be outside the Consumer Credit Code. So first question, how long do you need the money for? If we need it for anywhere from a month through to 12 months, tick box, quite possibly a short-term loan. When are the funds needed by? If there's a real desire around the time frame, then again, another tick. What are the funds then being used for? If it's business or investment and outside the code, tick again. Now, really critical, the next one here, how will the client repay the loans? This is the exit strategy, and this is absolutely critical in short-term lending. If people get stuck in short-term lending without an exit strategy, without a way to pay the money back, that's when things end up horrible for the lender, the broker, and the borrower. So how they're going to repay the loan in that short period of time is absolutely critical. Now, whether it's you're doing a refinance, but it's going to take 6 weeks to do it through CBA, and they really need the money by the end of this week, so we can do the funding for them for the 5 weeks while you're waiting for the CBA finance to come through. Other examples, it might be you can't get the refinance done until the tax portal is paid up to date. So we can pay the company tax debt up to date, bring all their taxes and their tax portal up to date, and then the refinance can go through. People have their house on the market and they're selling their house and they're going to invest the money into their business. We can lend them the money for the 2 or 3 months that it takes to sell the property. So there's always a really clear exit strategy on how they're going to pay the loan out, which is the reason why we don't need financials or tax returns. And when we get through to some of our products a bit later, we'll talk about that we don't need BAS statements or bank statements or anything like that. We don't need them, and we don't look at the client's ability to pay the weekly interest because we expect that there is a very clear exit strategy on how the client's going to pay the money back. And then lastly, what will be used as security. So in all of our short-term loans, we take first mortgages, second mortgages, PPSRs over cars or boats or trucks or what have you. So all of our loans are secured. However, if you get through those 5 questions and the client doesn't have any security to offer, it's not to say that they're not a short-term business loan. They may just be a loan for business fuel or for Prosper or somebody like that if they don't have the security to offer for the loan. So hopefully that part of it is really, really clear on how you can work out whether your client's going to fit into one of the products that is out there as an offering. Moving on, quick little quiz here. I didn't make these quizzes up, but what percentage of SMEs are looking for urgent funding? Because I hear a lot of people say, I would never have a client that needs short-term funding, or I'd never have somebody that's in that position. Well, it's really interesting here that 25% are looking for loans averaging 800,000. And 19% of all SMEs are looking for short-term lending. Now, I did some Googling this morning, and there's 2,065,000 SME businesses in Australia. Now, an SME business is a business that has from 0 to 19 employees. So 19% of that comes out at about 392,000 small businesses that are looking for short-term loans on an annual basis. So it's quite funny, the amount of brokers that I speak to that don't think they'll ever see anything like this until they're actually looking for it. Once they're looking for it, it comes across their desk a lot more often than they thought that it actually would. But there are a lot of companies out there that can really benefit from finance in the short-term space. Now, this is a little slide that I use to try and explain short-term lending to brokers on a whole at all the PD days and stuff that I do. So if you've seen it before, I apologize, but mainstream banking, CBA and those guys could be equivalent to you driving your own personal car to work every day. If I was to drive my personal car to work every day and it was to, it's 20 kilometers away, it's going to cost me a couple of dollars in petrol, and that is what it is. But when I'm flying around the country, which unfortunately we can't be doing at the moment, but when I do get around the country, when I'm in the airport, I obviously don't have access to my own personal car. Now, I can either get an Uber and if there's an Uber around, it's going to be cheaper for me than a taxi, and that will get me to my destination. Or if there's a taxi out the front and the Uber's 10 minutes away and I need to be at the FBAA conference ASAP, then I need to jump in that taxi and get to the city as soon as I possibly can. Now, to go that same 25 kilometres might cost me in the taxi $50 instead of $2 in my personal car. Now, does that make me a low socioeconomic person because I have to use a taxi and I don't have my own personal car? Not at all. It just means that in the situation that I'm in, I need to be able to jump in a taxi and pay that premium to get myself to where I need to be. And that's what short-term lending does. Short-term lending gets people from A to B when they're in a situation that they can't do it themselves through their business cash flow or what have you. So we have people that win new contracts and the contract might pay 30 days end of month, but they need $100,000 of material to get the first 2 months work done on the contract. If that's the case, they need to use short-term lending to get themselves to that stage of the project that they start receiving income back 60 days after they've started. Now, again, does that mean that they're a poor business? Not by any stretch of the imagination. It's just how some businesses have to get through a cash flow problem and take advantage of an opportunity. Or, as I said earlier, they're solving a problem. The problem may be that my tax portal isn't up to date, which means that my refinance with CBA can't go through. Well, that's a problem that needs to be fixed. We can fix that problem by paying out the company tax debt, which brings all of that up to date. They do the refinance with CBA and pay us our money back. So it's just a little slide there to try and explain to people what short-term lending actually looks like. And we've all used an Uber or a taxi, and a lot of people use them every week. So moving on into Strive Financial's offerings to some degree here, we have 3 different products. So our first product is our business bridging loans, and they are the taxi of that slide that we just spoke about. So anywhere from $15,000 through to $2 million. We don't have any minimum term at all. So if your client has the money for 1 week, they pay 1 week's interest and that's it. So there's no minimum 3 months term on this product or minimum 6 months term on this product, or we don't lock your client in. It works as a line of credit. They only ever pay interest on the balance outstanding each week. And if they have the money for 1 week, they pay 1 week's interest and that's it. Now, our funding timelines are typically within 24 hours. Now, I echo Pete's comments earlier for anybody that's tuning in from Victoria. It's obviously a bit of a nightmare what you guys are going through again, and it has affected us as well. We used to be able to turn the money around within 24 hours because I would physically fly to meet with your client. So for instance, we get an application this morning, we have your letter of offer an hour later. That letter of offer comes back at lunchtime today. The documents are prepared in-house this afternoon. I'm on an aeroplane tomorrow morning at 5 a.m. out of Brisbane to Melbourne, Sydney, Adelaide, Perth, wherever it is. I'd meet with your client at 10 a.m. tomorrow morning. They'd sign the mortgage documents and the money would be cash in their account half an hour after I'd met them. Now, obviously, that's not possible in the current climate that we live in, unfortunately. So it has blown our funding times out a little bit. The way that it now works, you'll still have a letter of offer within the hour. We can still have mortgage documents emailed to the client's lawyer the same day that we've received the letter of offer back. They do need to then have legal advice and sign the documents with their lawyer and have them posted back to us. So we're talking if everything runs smoothly and perfectly and your client can drop everything and get it all done, we can legitimately still have money to your client within sort of 3 or 4 business days. But it has unfortunately blown that sort of 24-hour time frame out just for now. We'll look at one-day ABNs. Again, we're not looking at trading history. We're looking at why the client wants the money. So it's got to be business or investment. And we're looking at how the client's going to pay the money back. Are they refinancing? Is the property on the market? Have they got outstanding invoices that are due to them? Are they waiting on a progress payment if they're a builder? All these sorts of different things. So we're not looking at trading history around bank statements and what have you. Security, we can take first mortgages, second mortgages, PPSRs over cars, trucks, boats, so anything of value there. Our loan preparation fee is $2,950. That's capitalised on top of the loan, so it doesn't cost your client a cent to apply for a loan with us or get a loan with us. So there's no establishment fees, application fees, valuation fees, desktop valuation fees. There's none of that garbage whatsoever. It's we're the lender, it's our own in-house funds. So we make money from interest. We don't need to make money from gouging fees out of your client up front. So it doesn't cost them a cent. If they don't get the loan with us or we don't fund them any money, it never costs them a cent at any stage. Loan terms 1 week through to 6 months. We don't require valuations. That's all done in-house on a desktop basis. We obviously couldn't turn money around in 24 hours if we required a valuation to be done. No upfront fees. It's a line of credit. The interest rate is 1% per week on the balance outstanding, and we lend in every state through Australia. Now, the interest rate 1% per week, I want to touch on this for a little bit because our next slide will explain that really well in the fact of what it looks like for a business 1% per week. Because a lot of people say to me, Cam, that's 52% per annum. Nobody is going to borrow money at 52% per annum. And you're exactly right. We do not do 52-week loans. So how we explain this is that it's a cost of solving a problem or taking advantage of an opportunity for a client. If it's a 3-week problem, it's going to cost them 3% to fix that problem. If it's a 10-week problem or a 10-week opportunity, then it's going to cost them 10% to take advantage of that opportunity. Now, how I can best explain this, and again, if a lot of you guys have seen me over the last 5 or 6 years with the FBAA, you would have heard the story that I'll talk about here in a minute. This next slide is just some differences, I guess, that set Strive Financial apart from other people in the short-term lending space. It also protects your client from some of the things that we're going to talk about in a minute that you need to really look out for in short-term lending. We have no upfront fees or charges, so your client cannot lose $2,000 or $3,000 in an application fee and then we not give them any money, or a valuation fee and we not give them any money. They don't pay a cent up front. 24-hour cooling off period. If they decide in 24 hours time they shouldn't have taken the money, I'm not sure this was the right thing to do, they can give the money back and there's no interest charges. All our loans act as a line of credit. So we don't do the loan for 100,000 and then say, oh, the interest for the 3 months period is 12,000 less the document fee, less this, and we keep 100, or the loan's 100 and we give your client 75. They all act as a line of credit, so they get the whole 100 and they only ever pay interest on the balance outstanding each week. We don't have valuations. No minimum term is really, really important. All our loans are non-recourse loans. The reason that we can do all of this stuff is everything's done in-house. So we're a small family-run company. My little sister is the in-house lawyer. Her husband is the other director, so it's just the 3 of us. So everything is done in-house. Our mortgage documents are done by Casey. Our letters of offer and our decision-making is all done in-house. And it's all our own funds that we're lending to your clients. So we're not just another broker in the market trying to get you to bring us loans and then us have to find a spot for them. We are actually the lender, which is quite often a lot different to a lot of people that play in this sort of space. Now, this is my little can of Coke story, and back to our 1% per week and who would ever pay 1% per week on a loan product. And I simply explain it like this. If it costs a cafe $1 to buy a can of Coke and put it in their fridge and they sell that can of Coke for $2.50, there's $1.50 to be made on the transaction. Now, if they don't have $1 to buy the can of Coke to put in their fridge, they can't make the $1.50. It's an opportunity that passes them by because they don't have the capital to do it. Now, if they were to borrow that dollar from Strive Financial to buy the can of Coke to put in their fridge, that would cost them 1 cent a week in interest at 1% per week. So if that can of Coke sat in the fridge in the cafe for 4 weeks before it sold, that can of Coke has now cost them $1.04. Now it sells at $2.50, and instead of making $1.50, they make $1.46. Now, I don't know anybody that's on this webinar listening to this that wouldn't make that deal. Everybody would make that deal. If I could buy something for $1, sell it for $2.50, but it was going to cost me 1 cent a week to have it there, even if it sat there for 12 weeks, it's cost me $1.12 to buy the can of Coke, and I've sold it for $2.50, and I've still made $1.38 on the transaction. And in its simplest terms, that's how short-term finance works. Although, as I say, 1% per week sounds scary, and people say it's 52% per annum and no one would ever do it. When you're dealing with businessmen and women that understand the difference in the cost of missing out on the opportunity versus the cost of grasping that opportunity, you're dealing with people that understand how much they're going to make, how much it's going to cost them, and whether it's worth doing or not. These types of products are not products that you are going to be able to sell people into. All you need to do is give them an offering. They will then work out whether this offering helps them or doesn't. Now, if the can of Coke was $2.30 and you're going to sell it for $2.50, well, then you wouldn't do it. So, and that's where businessmen and women will make their own minds up after you give them an offering of, I can help you with this, I can fix that problem, we can take advantage of this opportunity, this is what it's going to cost. They then will work out whether it's viable or not. I hope some of this is making sense. This is a lot harder than I expected, talking to myself into a computer screen. So hopefully you're still following and we're all on the same page. Our second product that we have is a medium-term product. So loan amounts of 50,000 through to 250,000. This one is a little bit different to the first offering. It has some similarities, but it does have a minimum term of 6 months, but the interest rate is halved, so it's 2% per month on the interest rate. So instead of the interest rate being 1% per week, with the flexibility of being able to pay out whenever you want to pay out, and acting as a line of credit and having no minimum term, this one does have a 6 month minimum term. So what we find with people that think they're going to have the money for under 12 weeks will do it in the short-term product. People that think they're going to have the money for over 12 weeks will do it in the medium-term product, because the minimum cost here over 6 months is going to be 12%. So they work out really quickly on, I only need it for 4 weeks, I'll do it in the short-term one, although the interest rate is 1% a week instead of 2% a month. It still suits me better to do it in the short-term one. People that are going to need the money for over 12 weeks will typically go into the medium-term funds there. So first and second mortgages, again, the loan preparation fee again is fully capitalized, and that loan prep fee on all of our products is no matter how much the client's borrowing. So we don't have a loan prep fee of 1%. So if it's $1 million loan, it costs your client $10,000 to have the documents done. And if it's a $100,000 loan, it costs them $1,000 to have the documents done, because to us, that's just never made sense. It doesn't seem fair. It seems like a cash grab. Our loan prep fee typically includes all of our flights, all of the lodging costs, the preparation of the mortgage documents, the searches, everything is covered within that loan documentation fee or the loan preparation fee. And that's why we pride ourselves on, as I say, it's $3,450, whether you're borrowing 50,000 or 3 million, that doesn't change. Loan terms can be a little bit longer here, so minimum 6 months through to the 18 months. Again, we don't do any valuations. They're all done in-house. Again, there's no upfront fees or charges. It doesn't act as a line of credit, this one. So if you do borrow 100,000, then you are charged on the 100,000 for the term of the loan. 2% per month, and obviously available Australia-wide again. Again, a couple of takeouts out of that stuff. Again, no upfront fees or charges. Again, it's all our own funds. We don't do any valuations. They're all non-recourse loans, and everything's done in-house, again by Casey. So the next one we're going to talk about here is our longer term fund. This works more as a mortgage fund style product. So our rates are from 10.99% per annum on this product. Minimum loan amount 250,000 through to 2.5 million. Again, with a minimum term of 6 months. Now, this one does take a little bit longer to turn around because we do require a registered valuation to be done on the property. And we can only use first mortgages on properties in this product. Again, our loan prep fee is $3,450. Our terms 6 months through to 3 years. The only out-of-pocket cost to the client on this product is the valuation at cost. So if it's a residential property and the value is $660, then your client pays the $660 valuation at time of signing the letter of offer, and that's it. There's again no establishment fees or application fees or anything like that that are paid up front. This one also doesn't act as a line of credit. So the amount that the client borrows over the term, that's the interest that they're going to need to pay. So where we're seeing a lot of people use this with us are developers, guys doing house and land packages. One of our main differences here is that when a developer borrows money from us, let's say they borrow it across 10 blocks of land and they're selling those blocks of land off. Typically at the big banks, if they've borrowed $1 million across the 10 blocks of land and they're worth $200,000 each, so it's $1 million lend against $2 million of security. Most financial institutions will take all proceeds from every sale until they've been repaid. So they sell the first block of land and they get $200,000 for it, and the bank will take that $200,000 and reduce the loan to $800. Second block sells, same thing. They take the $200, reduce the debt to $600. But the problem here for the developer is that they're not getting any cash flow. So until they sell the sixth block of land, they don't see any money whatsoever. So that may be 2 or 3 months down the track before they get to that stage. Where we differ and where we've been able to pick up a lot of business with the developers is that we will just leave our LVR stable. So if the LVR is 50%, being $1 million against the $2 million of security, if they sell one block of land for $200,000, we take 100, which reduces our debt down to 900, which still leaves it at a 50% LVR of the security, now worth 1.8 million. And the client, the developer, gets $100,000 in his pocket from the sale of the first property. Now, cash flow is king in any business, and that really helps them in moving on with the next project, whether it's stage 2 or whether it's the purchase of the next one or whether it's paying wages or whatever it is. So although our rate at 10.99 is going to be more than what they're paying at a bank, it might be 4 or 5, 6%, somewhere around there. Again, we're talking about loans that are maybe 12 months in term. If it's costing them 4% more to have that cash flow there, it is well and truly worth doing for them in that process. So we're happy to do land. So we do land banking, vacant land we have no problems with. We don't have a construction facility, so we can't do any construction funding. But there's all sorts of different types of stuff that we can look at in that longer term product. So moving on now to another quick little quiz here that is going to lead me into the next part that I want to talk about, which is how we need to be careful of some people that play in this space. And we're talking here about trust in lenders, and the stats was 2.4 out of 10. So that's not a great reflection on the industry as a whole. And that's where we pride ourselves on being different to a lot of these guys, which is why we don't have the upfront fees, the upfront charges, the massive document fees or establishment fees. We've been very lucky to be with the FBAA and be around the country 5 or 6 times or it would be more than that. It's been 5 or 6 years that we've been with the FBAA, so we've probably been around the country 15 or 20 times, speaking to brokers like yourselves about what you need to look out for and how you can point your client in the right direction, so that we don't end up in the 7.6%, 76% of people that don't trust this sort of space. And this is one that is a perfect example of something that you've got to be really careful about, and you have to go through some of the letters of offer that you might receive with a fine-tooth comb to actually work out what it's going to cost your client that you're putting them into, because it's not always about the interest rate, especially in short-term lending. It very rarely is ever about the interest rate. It's about everything else that's going to be charged on top of it. So I had a broker come to me with a letter of offer that he asked me to have a look over. We weren't going to be able to compete on the interest rate because it was 2.5% per month was the interest rate in the letter of offer. And obviously our stuff is at 1% per week, so we weren't going to be able to compete on something like this. But when we went through the letter of offer together, we quickly found that the interest rate was only just the beginning. So the client first off had a minimum term of 3 months. So you had to have the money for at least 3 months. So you're up for 262,500 straight up. They also had upfront fees. So when you sign the letter of offer, you had to send the letter of offer back along with $49,500 in cash, which is a $33,000 application fee and a $16,500 valuation fee. On top of that, the capitalized fees on the loan was an $11,500 establishment fee, a $38,500 legal / documentation fee, and a $33,000 exit fee when you paid the loan out. So if we're just comparing for a second here, we might be 1% per week, but you're not risking $49,500 to maybe or maybe not get the loan. And you're definitely not paying a legal fee or establishment fees or exit fees. Our legal fee on this deal would have been the loan preparation fee of $2,950, and our exit fee is $250. So you can see here that it all adds up pretty quickly, and the total cost of the loan is $498,500, which ends up over 15% for a 12-week period. So our product at 1% per week would have ended up being 3 or 4% cheaper than what this product at 2.5% per month was. And it's why we've got to be really, really careful, because people will try and sell you in the short-term industry off an interest rate, and it's very rarely the most important part of the deal that you need to look at. Now, some other problems that we had with this letter of offer was that the LVR was calculated on a forced sale basis. So they were going to lend a 50% LVR on a forced sale basis with no obligation to provide the valuation. And then if the letter of offer was withdrawn after acceptance, the loan documentation fee of $33,000 was payable, 50% of the establishment fee was payable, and a 2.5% of the total loan amount was payable. So if the loan fell over, you were quite possibly going to be up for $178,000 out of pocket. Now, we do all our own desktop stuff. If the loan's not going to happen because the property's not worth what you think it might be worth, then it hasn't cost you a single cent. Where here, you could have been up for hundreds of thousands of dollars in fees on a loan that, when I did a simple desktop valuation, was never ever going to value at $6 million on a forced sale valuation, which is what it needed to val at to be a 50% LVR for this loan to even happen. So they would have spent $49,500 and sent the letter of offer back. The valuation, I guarantee you, would have come in nowhere near $6 million, and the loan would have fallen over because of the valuation on the LVR, and your client would have burnt $49,500 straight away. I had another one the other day with a broker call me a lender had charged an $850 desktop valuation fee. So they got a letter of offer, signed the letter of offer. The broker, out of the goodness of her heart, paid the $850 because the client didn't have it. She paid the $850 and 2 hours later got an email back saying, sorry, the property failed the desktop valuation. Now, I can promise you that company makes $850 per letter of offer they send out on a desktop valuation fee. And once you pay that $850, you are never getting a loan through them because they actually won't have any money to lend. They send letters of offer out, get an $850 desktop valuation fee, and that's how they make their money. Again, you cannot get burnt with Strive Financial in any of those ways, simply because we do not have any of those fees. We do not have any of those charges. Your client does not pay a cent upfront to get a loan with us, and we've always prided ourselves on trying to bring some respectability back to an industry that can get messy and has a reasonably poor reputation around it. I don't know how I'm going for time here, guys, but I'm almost done here. A couple of reasons to partner with us. Again, no financials, no credit checks. Again, that's not being irresponsible. People say, how can you not do financials and credit checks? At the end of the day, we want to know what the exit strategy is. How's the client going to pay the money back? If they don't have an exit strategy, it doesn't matter how good their financials are or how good their credit checks are. We won't lend them the money. So it's absolutely desperately important around their exit strategy. And that's why, again, we don't need the financials. We don't need the credit checks. We have minimal fees. Our settlements are quick and simple. Our application process is a 2-page application form along with a rates notice and a mortgage statement. So it is very, very simple. Around brokerage, for you guys, you can charge as much or as little as you like. It's capitalized on top of the client's loan, but we pay you at time of funding the loan. So you can literally fill in a 2-page application form, send through the rates notice and the home loan statement, and in the COVID times, 3 days later, have your $2,500 brokerage, $5,000 brokerage. If it's $1 million deal, it might be a $10,000 brokerage paid into your account as cash the same time that the client gets their $1 million in their account as cash, all for filling in a 2-page application form and sending through a rates notice and a home loan statement. So it couldn't be simpler. It is very, very easy. We don't muck you around. If you can send an application through and you'll know within 15 or 20 minutes whether we can help you or not. Now, if we can't, at least you've got an answer quickly. If we can, then you have an offering that you can take and give to your client. And as I say, in our space, you're dealing with businessmen and women that understand the cost of doing business and what they're going to make out of it or what problem they're going to solve. They will then make the decision on whether that's viable for them or not. And if it's not, that's fine. It's no problems in the world. So a couple of takeouts from the last half an hour, guys. You're looking out for businesses. As I say, you will all have SMEs on your books, I would assume. So remembering that they are looking for this style of finance. There's more than one way to go from A to B. There really is. And again, back to the slide where we spoke about your private car versus an Uber versus a taxi. And always look beyond the interest rate. As I say, in short-term lending, the interest rate really is only one part of the jigsaw puzzle. Those other upfront fees and charges, establishment fees, application fees, valuation fees, exit fees, risk fees, Cam needs a new suit fee. They really are everywhere, left, right, and center, and you have to be really, really careful around it. So thank you so much for your time. Whitey, I think I can hear you back there, mate. Again, I'm not very good with this technology stuff.
No, you've done well, mate. Sorry about that. I turned my mic on in preparation and I was just laughing after the Cam suit fee. I thought you could
be a fee for anything, Whitey. Seriously.
Very funny. Now, listen, important note. What a lot of people don't understand is that when you're used to speaking in front of audiences and face to face, it's all fairly natural. Trying to speak in front of a screen to a camera and there's nothing coming back on you, it is quite difficult. But the important thing to understand for you, Cam, talking to yourself is okay.
Yeah.
Answering yourself is a bit of a worry. Believing in your own answers, mate, you're in a very dark place, and I suggest you move on if that's where you are.
Whitey, I can't believe how actually difficult this is. You can't even see a picture of yourself. You're seriously just talking into a PowerPoint presentation, just going.
Don't worry about that. I've got to look in the mirror every morning. I'd rather not look at myself during the day. So now, before we get into the questions, we've got some questions come through. I just want to make just a little point on this for everybody who's watching. So we've got hundreds of brokers right around Australia joined us today. It is very, very important that you make sure that you act in accordance with your aggregator's agreement. So if your aggregator says, if you're doing a non-code loan and you can work off panel, go for it, so be it. You just go for it. If your aggregator says you can't, you must only act within your panel, then you need to do that. And I would suggest, if you like what Cam's been talking about today and he's not on panel with your aggregator, you need to get onto your aggregator and get Strive Financial onto the panel. So just make sure you act appropriately, because we don't want anybody stepping into a bucket of doo-doo that gets them into a whole lot of trouble. Mate, I love the analogies. Now, you know, this is my 42nd year in the banking and finance. I was broking from the late 90s through the 2000 periods. I did a lot of commercial stuff and short-term stuff. And your analogies around, the car and the Uber and the taxi as to the appropriateness of it, I think is just really bang on it. And the can of Coke analogy brings it right home to understand that, yeah, if it costs you 4 cents or even if it costs you 12 cents on top of the dollar you paid, you're still making $1.38 somewhere. Now, from a business person's head, what I need to do is to sell the stock. And if I can't sell the stock, I'm going to go broke. So being able to get out the door, even if you lose, 4 cents or 12 cents out of the $1.50 profit you would have made, you're still miles in front as if you didn't do it at all. So I love those analogies that you tell. I think they're so appropriate. In addition to everything else, I mean, the important thing people need to understand is this man's the lender. He's not any sort of intermediary. It's their money. They've been doing this as a family business since Adam was a boy. I can remember when I was brokering, Crown and Gleeson was always around. I think Cam was in nappies in those days, but that's all right. So these are all really good points that are made. And I think where you started was a great foundation piece to ask those 5 questions, which principally revolves around what term do you want, how quickly you need it, why do you need it, how much do you need, and how you're going to pay me back, the exit strategy, because that's the core essence of how this works. And mate, well done. I would never have known it was your first time at it, my friend.
Thank you, Chairman. Yeah.
All right. Let's get to some questions. So I've got a question here from Joe who says, on the medium-term loan product, do you require security, and what's the minimum amount? Looking at a loan potentially around 40 grand.
Yep. Typically, we do require security. So on all of our products, and the short-term and the medium-term stuff, we can do second mortgages as well as first mortgages. So we'd need at least a second mortgage, and minimum amount is usually 50,000. But we'd be happy to look at that. Obviously, times are changing. We're in difficult times. I'm happy to speak to anyone about any sort of loan amounts that they need to work with.
Yeah, and when we close this, you'll all get an email with your CPD codes, but Cam's email address will be on it too, so you'll be able to reach him direct. So, so it's a bit hard, I guess, to answer what security do you need, because it depends on what it is, but you need some form of security. It could be a jet ski, it could be a car if you're doing a PPSR, it could be a property of some sort.
Most definitely, yep. And we do quite often do $40,000 against a director's BMW X5 that he just went and bought with cash, and then something's popped up and he needs 40 grand for a couple of months. Okay. We can give him that money against that car for those couple of months. We don't take possession of the vehicle or anything crazy like that. we give him the money against the vehicle as security. But yeah, we do need some sort of security on all of our loans.
Okay, so you also don't want to own a BMW. That's what you're telling me. I can hear that. You're a hard man. You're a hard man. BMW are friends of ours, so they're behind the FBAA.
Oh, I love BMW.
They love BMWs, yes. Glenn, who I know this man well, and he always will come up with very well derived questions. His question is, on the longer term loans, will you consider specialised securities or also residual stock, say from a development that's completed?
Yes, most definitely. So specialised securities, again, because it's all our own money here, we don't actually have a matrix that we just pump into a computer and it spits an answer out. As silly as this sounds, I pick up the phone and I speak to Jonathan, my brother-in-law, and we say, what do we reckon about this? So it is all really personal. The specialised security stuff, just the LVR will fluctuate. So definitely can look at doing it. Just depending on the LVR that we're comfortable with. As far as the residual stock, we actually do a lot of that. We just did one in Morrowfield here in Queensland. The developer had 17 of 40 odd townhouses left over. We were able to give him 60% against them, which gave him a couple of $1 million cash out at the start of COVID. So he's selling them down and paying that loan back as he does.
Nice. Okay, so residual stock, yes. Specialised securities, yes. And as we all know, it's all subject to LVR. And specialised securities generally will have a lower LVR, but it's a matter of being able to get the deal done. So I suggest you can get ready for a few emails. Sonny's asked, Sonny's asked, do you take commercial security? And if yes, generally, what's the max LVR?
Yep,
we're talking about general commercial property, mate.
Yep. So we've done a heap of commercial property in the longer term stuff. We do it in the short term stuff as well. Again, LVR is probably going to be top 60%, and then it work backwards from there, just depending on where it is and how, if it's rural or what sort of leases are involved in it or what have you. But yeah, typically somewhere around 60%. Yeah.
Okay. Another question here from Gary. Do you need a lawyer to sign docs in every instance?
At the moment, we do. Typically, we never need a lawyer unless the loan amount is over $250,000. I just fly and meet with the client. Currently, we do because we need the documents to be witnessed and we need someone to do their verification of identity because we used to do all of that ourselves. Now, listen, if they're in Queensland, it's still fine. I still go and meet with all our borrowers in Queensland, and it works how it used to work. If they're in Adelaide, I can still fly to Adelaide and come back, no problems. Can
you use a JP or a Commissioner of Declarations, or does it just have to be a lawyer?
No, they can, and they can do their VOI at the post office typically. Smaller loans, we'd probably be happy for them not having the legal advice, but probably anything over 100,000, just with the times that we live in, we've got to just be really careful, I guess.
Yeah, and I guess we are talking a moment in time, and I think we all got to be a little bit cognizant of that, is that COVID's a challenge. So the objective is to sort of understand how we deal with COVID until things reset, because I know for years, Cam is forever on a plane, speaking with clients, getting them signed up, getting loans settled, and because it's their money, this is why they can do it in such a quick period of time. So there's a means to adapt to the current world, so long as we're in it, depending on where you are. And it's the border restrictions become the issue,
which is
and how they play.
So the way that we've tried to do it, Whitey, just for a little bit of info here, is even if they have their legal advice over the phone, so it's just it's a legal advice certificate that the lawyer signs to say that they've given the advice. So we email that to the lawyer can email that back to us. Our clients have been having the advice over the phone and then doing a Zoom call with myself so that I take them through the documents and make sure they've signed them correctly so that when we get them back, they haven't missed something. We are trying to move with technology to make it as seamless and as simple as we possibly can.
Yeah, COVID has certainly brought some things on us quickly, and in some ways we can adapt quicker. Some things are a little bit more challenging, but we're getting there, and I think that's an important piece. Alan's asked a question, mate. On the 6 month to 3 year loan term, a client takes out 12 months, however, he pays out in 6 months. Does he pay the remaining term of interest? So this plays back to your other piece. So let's say he takes out a 3 year loan.
Yeah, it is a minimum term product. So if he takes it out over 12 months, he'll get a better rate than he takes it over 6 months. So he would be liable for the interest for 12 months. Once the 12 months period is up, then he can pay out at any stage. So if he took the money out over 3 years and paid out after 13 months, that would be fine because the minimum term would become around that 12 months.
Right, okay, so take out a loan for 3 years, hypothetically. Once you get past 12 months, you can pay it out at any time.
You can pay it out.
But it's a minimum period of 12 months.
Minimum period of 12 months, yeah, at that rate. We do have a minimum 6 month in that product as well, but they will pay a higher interest rate.
Okay, so you can do minimum 6 months, but at a slightly higher interest rate.
Interest rate will be higher.
Yeah, okay, fair enough. Don't expect you to be a charity, just to be nice people, which you are. And on that note, we've hit the hour line, and we're out of time. And Cam, I want to thank you so much. I think it's very important that people understand that there's some really good product in the short-term space, and you guys have, in my mind, have got one of the best, if not the best. So I think the explanations you've given today and answering the questions that we've taken on the run have been really fantastic. And I thank you for your time, and it's very much appreciated. This all is being recorded, so it's going to be on the FBAA YouTube channel probably early next week. And again, we'll be sending you an email very shortly with your CPD code for the hour that you've spent with us, as well as Cam's contact details should you want to get in touch with him. Remember, act in accordance with your aggregators agreement, and if you can work off panel, great. If you need to get him on panel, I suggest you work with Cam and the team at Strive to get them on panel with your aggregator. You can see how good their product is and how fairly they play with everybody, so you don't get burdened with significant costs that just don't need to be there. Anyhow, Cam, thanks, buddy. Good to see you. Everybody, thank you very much. Pleasure, mate. Pleasure. Thanks, everyone, for joining us, and we will look forward to seeing you again real soon. Take care, especially for our family in Victoria. Look after yourselves. Stay well. Bye for now.
Thanks, man.